Greetings, market rebels. Welcome to this week's macro measure combined with our sector situation video. And let's get right into our trusty disclaimer, along with our trusty intellectual property rights notice. It's there it is. Anyway, it's about 9:20 something a.m. here on Saturday morning. I did record a video at the end of yesterday's trading, but I don't care for the way that it came out. So I'm trying to redo this to save time for everyone while I still have a few moments here this morning. So let's get right into it. I'm just going to play a little bit of defense here at the start. I'm going to quickly work my way through several slides that were part of last week just to kind of remind folks. Apparently, there was a few folks that thought that our cocktail hour sounded bearish, whereas we were supposedly bullish. And I'm honestly just dumbfounded by that. I don't know where that's coming from. I haven't heard Greg or Ryan or myself sound uber bullish about anything. We know there's scenarios that can play out certain ways that could deliver a very bullish performance, but those sort of got taken off the table. And I think we actually in the nick of time last week went back to really an in-depth formerly tabs approach, tabs look, whereas I ended up just cutting and pasting a bunch of pictures that I took just to try to save time and put them in PowerPoint instead of cycling through tabs. There have been times when I've done 50 tabs or so when we thought risks were really building and the market was ignoring it and it was getting really long in the tooth and that they weren't going to be able to do it much longer. But we got away from that because not a lot of people care for these longer videos. That's probably the majority of people do not like longer videos. So they picked the wrong guy. I actually volunteer, but they picked the wrong guy to do these videos because that's just not my style. It's just naturally not my style. It's the opposite way. I just my own personality quirks or whatever. But I thought that all hell could break loose was a pretty good thing to put up last week. You really don't see, I don't think that type of hyperbole from me very often. I try to avoid that because a lot of times all hell doesn't break loose, so I'm not sure where that's coming from. I'm not going to belabor that anymore. But if you look at all the highlights here in purple, I think that we did raise some good points and talked about how there were issues that were just not being addressed by the market, and they were just becoming more and more detrimental to likely to the market's future performance. And the market really can only ignore those for so long. It's always tricky. They do a great job of ignoring all these things, and I've said it several times. They ignore it to the point at which they're forced to then confront it or acknowledge it, or they decide to. And really, the toughest part I think of last week was the EPS season wildcard monkey wrench. Me kind of just being ridiculous with all the cliches that I try to throw in, but bottom line is you just don't know how that's going to go, unless you're someone that's really got an ear to things. Some folks do because they're in spots in business and they can see and hear what's happening, but that's obviously I spend my time in front of the market all week, so I don't have time to do both. I wish someone would team up with me that's got their ear to the beat of the economy. But it looks like really for my taste, I don't know what else we could have done, frankly. I went through so many different things. I showed this 2 weeks in a row. This was really my main, I guess, focus, because I thought, look, this is really building up bad. And if the mask comes off, if the economy is unmasked and shown, more clearly, more truly, genuinely, then suddenly there'll be a massive recognition potentially. And I don't know if that's what started here, but it seems like that's what started here to me. Maybe. So we'll see. I'm not super bearish in terms of, hey, we're going straight to hell in a handbasket. I think you certainly could get smashed hard for a while. but I also expect them to intercede. So that's the problem, right? I think if there's no my take on it is if there's no war that erupts over the weekend, or new war, new conflict in the Middle East, and the Fed does not start to lower rates with some kind of an emergency cut, or indicates there's going to be some action between meetings, that this market is probably headed lower. That's my take. But those items are what make it very challenging. But I really did. I thought that all the stuff that I probably showed in the nick of time last week, I thought that all these things were making the point that there could be this realization, and it wasn't just luck in terms of like, hey, we let's just do this to kill time in a video. It was more of, what if my motivation was, what if all the stuff we're seeing has to finally be confessed to by CEOs, and the C-suite during these conference calls, and the results themselves wouldn't be where it could be, right? It just could be. I didn't expect it to be. It, I didn't expect things to get shelled immediately. I thought it would take more earnings to play out, but often they don't wait for that, right? They just start reacting and then selling begets selling. But that's the whole reason why I went through this last week. It wasn't just it was fortuitous timing, but it really was motivated by trying to just time it along with what could happen with these CEOs. And like I say, on all the conference calls, that's really why I spent the time thinking this is probably the time that this could be revealed. That's really all that it was. And we hadn't done it in a while. And despite all of our comments during weekly webinars, not everyone is in all those webinars to hear the latest thing that we're sharing about the risk side of the equation. And the risk side of the equation is what often gets lost in the shuffle by retail traders, by regular everyday traders, not professional traders, but very often, but definitely the retail side. And complacency can catch everybody. I know complacency is a real thing because I've been guilty of it myself. And so having been victimized, allowing myself to be victimized is probably a better way to put it. I try to make sure that doesn't happen as to folks through sharing what I can. That's really part of what motivates me. But yeah, I was just a little caught, kind of like like just befuddled with the comment of what happened. You guys were all bullish, and I did make a comment about Tom Lee on Cocktail Hour, but it wasn't really a Tom Lee bash. He's pretty much at this point known as a perma bull, which I don't know how you can always be bullish, but we're bearish. But it seems like that's his take, is generally just to be bullish. I know it pays to be bullish in several ways, so I'm not faulting him there. But my bash really wasn't about Tom Lee. It was the CNBC ballyhooing that I was bashing, right? Where they always take this sort of analyst of the times, and then they get people really frothed up in a frenzy over certain opportunities. And then once those folks have gotten themselves in on the CNBC hype, then you often see a rug pull shortly thereafter. That was my bash. I hate that they do that. Somebody should be there to say, look, there's been a really big gap. You got to be careful. I wish this thing would have just slowly worked its way to this point, but it didn't. We could have a little bit of short-term volatility here. So be careful if you're going in for a trade. Just it would take a moment to say that. And they really just maybe they did this time. I didn't catch these ballyhoo sessions, but historically they didn't. It was all just, okay, well, all right, there's no doubt you're bullish. We'll see you in the future, see how things work out. That was pretty much it. But risk is really the most important factor, and we have to always keep sight of that. You've got to go for the profit, sure, but you have to do it in a smart way. Otherwise, the market has a great way of ultimately upending you. So in terms of the rest of the year, I'm not going to cover everything. I do think that the market went risk off. I do think that we're in a volatility storm until further notice. I definitely believe there's more downside as I've already said, if the Fed does nothing. So, and if the war breaks out and the Fed does nothing, it's probably, a good reason to sell even further. I don't necessarily think that the bull market is over. It could be, but I mean, I think it's definitely too early to tell. I think the long-term trend still remains up. I do think, though, that with the VIX sweet spot we talked about coming into July and now into August here, I do think that was worth keeping an eye on. I did mention that in Cocktail because these tendencies are not something you can bank on, but I think they're good things to kind of keep in mind. Like, okay, well, things are sort of working out the way they normally do, and normally if the VIX goes up significantly, that's not good for stocks, right? It should have you ready at the very least, in my mind, to collar your longs if you really want to, right? If you really want to avoid giving back a lot. The worst thing you can do, I think, psychologically, is to bust your butt building up a nice year for yourself, and then really within just a few weeks, give a lot of it, if not all of it, back. And that can happen. And that's why the market is tough on people that I think don't adjust. If you just sit there, otherwise, I mean, as a trader, otherwise, if you're an investor, I guess it doesn't really matter in the long term if you've got a long investment horizon in front of you. But in the short term, if you're a trader, it can really be obviously very painful. So, look, I went in depth last week on the wheels falling off. That's not something I'm going to belabor. The new news out, I think, this week confirms that. So, but I'm just going to skip news. Apparently, all the stuff last week didn't really have much of an impact, it seems, where people still think we were bullish somehow. So I guess maybe it's not worth it after all. But I don't know what else I could have done. Maybe I should have lit my hair on fire and ran around Times Square with a "I'm very concerned" sign in my hand. But I actually, now that I think about it, I don't even know if that would stick out in Times Square these days. But I'm just going to start charting, really. I think the market behavior this week confirmed that the Ponzi has at least hit a detour. And as we noted, and even earlier in this video, there was a slide that essentially showed how this has really been nearly entirely debt-based. All they've done is increase the debt and to just cover over the inadequacies that are within this market, the issues within this economy. And they've flooded the markets, flooded everything with a lot of liquidity too, sort of like stealth QE, as people call it, all to keep this mirage going. And the mirage has been maintained for decades now, and maybe even longer. So at some point, I don't know how long you can keep working. I don't know how productive it really is in the long run to be more focused on mirage maintenance than actual wealth creation. But what do I know? Anyway, the EPS wildcard monkey wrench is still upon us, but we now have these big issues, which are the FOMC emergency rate cuts. And then remember, this is coming. All the Wall Street banks pretty much are clamoring for this to happen sooner rather than later. And this is supposedly after the economy grew at a 2.8% Q2 GDP. So I don't even know what to say anymore. I mean, we're definitely not we're in some bizarro world. Obviously, we have been for a long time, where they just absolutely need the juice, or they feel like the whole thing's going to fall apart. And it probably would, unfortunately. Over the weekend, war escalation, there's no doubt that's a big issue. So I don't want to belabor any of that. It's just that I felt like it was necessary to at least show for whoever these folks were that, I don't know where that's coming from. Maybe they have us confused with other people, but that just wasn't the case in my recollection. I felt like the all hell break. I mean, I debated actually doing the all hell breaks loose, whether I should do that or not, because it's a pretty hypey comment. But I did feel like, with all the masking they'd done, that if the rubber did meet the road and these CEOs had to sort of do the old, mea culpa, things didn't really work out as well as we were hyping it, that could really be a problem given the way that the market was priced and the fact that we hadn't had really a correction. We've had a pullback that was back in here, but we haven't really had a serious correction in some time. So let me, I want to see if I can um, get rid of a few things. I just dumped that for now. Well, I'll leave it up there in case anyone wants to look at it as a matter of fact, but I probably really want to see if I can, well, I'll leave this up there just in case anybody wants to notice that while we're talking about it. But what I'm going to do is just go to these charts because they're a lot cleaner than my other charts on Thinkorswim for these big dog major index ETFs. Let me just take the retracement out of the way. So what I did in the prior video was I did this all in real time, thinking maybe that could help people, but it took a really long time. So I decided to, again, that's one of the reasons I decided to record this other alternative video here, which will not take as long. But I do have recollection that we said, right, just again, here's your SMA stack. You can see all the ones I'm running on here. And the 200's the blue, the 100 here is the red, the gold color one's the 50, and then this blue one up here is the 20. Those are the main ones, but I have other ones in there because I do think at times the market pays attention to them. I don't want to go into my SMA opinion. My SMA opinion is just that basically that the reason why this is important to look at is because so many people do, not necessarily because the concept itself is really valid, but it doesn't matter if people pay attention to it, right? That's really what matters. Anyway, they held that 50, and we said if they didn't hold the 50, the next stop you look to is the 100 in red, and that's pretty much where we got to. They exceeded that a little bit in SPY, as they often do. There could be people with too tight of stops. It could just be natural price action, but whatever the case may be, that's where they brought it to. And interestingly, you could see really, if I drop this flat line in here, there was a flat line right near there as well. I would say that it's probably probably right about here is the flat line. So there was a flat line right near there. You could see all my levels over here. The levels that are white are going to be your flat lines. So if you want to just pause the video and take a snapshot, these are really the flat lines that I would look at. Now, the other ones are going to be SMAs. So if we mouse over here, you see that 529.29 right there, that's your 100, right? And so you can see how they kind of correspond to over here. The 150 that I run is right near 516 and change. So what I would say right now is that clearly, right, we are back in the news situation. I don't think that the earnings are going to be enough at this point to have the market completely recover, but they could give enough of a pop if there was some internal plumbing issues that helped the market go down. If there were OPEX issues that helped the market go down, then they could be quickly reversed on further EPS reports. That's what's quite possible. I don't think personally that it'll be just a few weeks and we'll be right back at the all-time high unless the Fed really does do something. And I think the initial reaction that was part of our cocktail discussion, my recollection is that when the Fed does these kind of emergency cuts, if you want to call them that, they typically rally the market, and then that phase, and it sort of dawns upon people that if the Fed's doing this, when they just had a chance to cut and didn't, now that they're doing it, then they're seeing the wheels come off somewhere. And that usually spooks people, and people that have had a good run say, you know what, maybe it's time to cash out on more, and selling begets selling, and you usually get a whole nother sort of selling phase. So we had one gentleman say he thinks the opposite happens. He thinks we actually sell off on that, and then we rally really throughout, I think, the year. He could be right. He said, I think it's different this time. He has a thesis on it. Could very well be the case. I don't know, but I don't really, as all of you know, or most of you know, I don't really trade things that way. I'm just going to trade off of the price action and the scenarios that are playing out. And as long as they keep tracing out what we think is going to is happening, we just stick with them. And I would just say again, you're back. You got to remain in my book in your singles, doubles. I'm super disciplined mode with a lot of rolls because you could have breaking news, And I've had my TV really tuned down because it's just after all these years, it's extremely difficult for me to listen to the modern CNBC, Bloomberg. I don't care for that either. It's just, I can't, I just don't care for what's become of business coverage. I think it's become silly and too politically oriented. And I think that you should just talk business and really in a, excuse me, in more of a sober fashion, talk about what's really happening and talk about the risk side so people don't get clobbered. But again, like, I guess that doesn't sell. So that's why they do what they do. They've got it. I guess they know better than I do. I wouldn't, I just don't care for it. But you just don't know when the market could start screaming back up and you'll be perplexed as to what happened. And then if you don't have the TV on, you might not see the headline fast enough. And you might find out that, oh my gosh, the Fed just cut rates in a big way. That's something I would say get your TV on, even if it's tough to listen to, because they might catch the story or wind of it quickly. Whereas if you're not paying attention to your headline scroll, you might not see it right away. Anyway, with this, you can just see the levels. And I think really, right, the reason I'm doing it this way this week is more because you can see that I think that there's more downside potential here. There's gaps that we can go back to. Let me just kind of scrunch this so everybody can see it. And there's one here, and in other index ETFs, there are others. And I don't normally worry about gaps while the market is moving away from them. But when things take a major turn and it seems like it could be an inflection point, that's when I start to really factor gaps into the equation when we're kind of on the return journey. And there's another one right here that I'll put something there for us to remind us. There's maybe a couple right there in this vicinity. And those are obviously the ones that would concern us first. So, that's what I would say, but I would just stick with this. I think that between the flat lines and your SMAs, the 150 here makes sense to me because you've got the rising 150 near about 517. You've got this flat line right near 517.44, which is probably could even be rounded lower. I'd have to really look at the data. But then also, if I drag this over for everyone, and I put this where it belongs, and I regret sort of in a way that I have to do this, but let's see if it lets me do that. I'll get the exact right numbers on here. Oh, it's giving me horizontal line. I want this. So let's see if it lets me get that. The fib retracement. So the high that we have is 565.16, but I've got to change this to get the exact high. And then over here, and I'll just move this out of the way. And our lowest low that I'm taking this from is 493.86. So I have to adjust that slightly. And there you have it. And so if you notice, there's no fib retracement that, wait a minute, it's not giving me the, I've got it. I think I might have it inverted here. My bad. I apologize, folks. I'm trying to use something that I don't use this feature that much in my TradingView account. So I apologize because I somehow flubbed this up. Let me go back to, it was I think we had 565.16, right, on this one. And then we had, on this one, we had, let me get the low. I apologize for the waste of time here, 493.86. I think between all the different pieces of software, I've got to keep consolidating and get away from everything. I've got to just stick with one. But I've got Options Robot that I use, which is based on TradingView, but has different things in it. And then I've got, Thinkorswim, and I've also got TradingView. But getting back to this, there really isn't anything directly near there, but that's the strong point, right? The confluence area is what I like to see as kind of more of a major support. And so let's make the case that you had the 100 SMA right here. You also had the fib right there. You can see the 50% fib retracement. And you also have a flat line that I've got drawn right there as well. So you had three reasons, right? Three different approaches that told you that that should be support in that general vicinity, very close to there actually, and it did for now. So the question now becomes: do you bump? Do you bump back up a little bit? Do you fill the gap, and then do you roll back over again? I wouldn't be in a panic on the SPY if I were a bear, where I would be completely capitulate until they close it above this high. That to me is what you're trading against in a bigger picture way. And the shorter term, right? You'd have to really see what happens Monday, but I think that there's more downside potential here. I wouldn't rule out a kind of visit towards that 200 if the Fed sits on their hands, and the Fed may just say, like, we don't want to look too political. We only want to have one thumb on the scale, not two. And so they may say that they really want to wait till the market is the market participants from Wall Street are really crying and moaning, gnashing teeth before they're willing to go with the emergency cuts. It might look a lot more justifiable, and then CNBC will have a special about how the Fed saved the market, that kind of thing. So it's a tough call, and that's why I think you just have to keep expecting volatility. And if there are no cuts, and especially if this war starts escalating or there's more conflict going on, I think you're looking at more downside. And I really do think your initial gap fill here and the 200 probably be working its way up a little bit towards that. So I think that that's probably, if you're looking for a little bit bigger picture, 504 is probably a decent number. 505, somewhere in that range, is probably a decent number for if you believe there could be a larger pullback. So those are all the levels. I wanted to make sure everybody had those. You could tell that the colored ones are really more or less based on the SMAs, whereas the white ones are based on your flat lines, and the fibs are right in here, that you can see. Let me just turn that off briefly. So that's that one. Let's go to Qs. And I'm going to have to reverse this because I'm used to doing it a different way and didn't even, I'm actually glad I'm re-recording now, because I didn't even realize it, that I was having trouble with that until now. So that's good that I'm redoing this, because otherwise these numbers would have all been off, because I didn't realize I was doing it the kind of think or swim way, or options robot way. That I can't remember which one I went to. 503.92. Let's just bump this up a little bit, and then here's our low at 414.60. No, I'm sorry, that's not 44. It's 413.07. Okay, so let me do 413.07. This will give us a better fib situation in there. And let me try to expand this more so you can see these numbers over here for the fibs. But I did put flat lines in here ahead of time, so that everybody could have those. Ryan and Greg might have different ones. I'm looking at it my way, which is similar to theirs, but everyone's got their own little quirks. And I definitely admit that I've got probably more quirks than most people in terms of like the little charting things that I like to do that are slightly different, not by design, just by observation, really. Wow, this keeps resetting on me. I'm sorry about that, folks. I wish I could, maybe I should just, wonder if I could just get rid of, I'm trying to recall how I can just get rid of the volume on this one. Maybe that would help us a little bit, but let me just pull this down. Hopefully everybody can see that. I do have some notes about these icons, right? So there's your gap right in there. There's another gap back in here that is unfilled. Again, I don't worry about gaps when they're going away. After 5 days, it doesn't matter to me, just to be succinct about it. But once you're on the possible return journey, then I start caring, because usually when there's a major sell-off, like we're potentially seeing here, it's already been a pretty significant one. Then that's often the times when they'll just let things get overdone, and that will end up in a gap fill or near gap fill. And that's going to be right near the 200 right there. So, oh, and I did it. See, I did it again. I got to fix these fibs again. Oops. Now my mouse is fighting with me. Okay, well, for my next clown performance, I'll be back. Yeah, something about this. I think it's a combination of my mouse and other things. Wow. It's not letting me hold things the way that I want. Yeah, I don't know why it's doing this to me. Jeez. I have to move this manually to get it in a better position. That's close enough, I think, for now. And then wow, it's just giving me fits. Let me see if I get this down here. Fix this a little bit. My apologies on that too. Oh, guys, I don't want the Asian session range. Boy, this thing's really fighting with me right now. Okay, let me go back here. 503, 52. Now that's going to be 503.52. And then down here, I have to grab this low, 413.07. Okay, just click my way to that. Risking trouble. So there's the retracement, sort of drawn a little bit better. We did get past the 0.618, and the next one that comes in is the 0.786, which is going to be near a flat line that I've got noted near. This says 432.43. We have a flat line at 434. And your 200s in there. So there's a little bit of a zone here right near really this gap. There's a zone of potential support there if we do get further downside. So that's where I would look to on a bigger picture basis. If you were saying, well, I think there's more to go, I'd rather try to wait this thing out. I think it's going to be a bigger payoff. I'm not really into the singles and doubles thing that you're advocating. Remember, a lot of these things are not oversold completely yet. Now they're getting towards that. In a bull market, if we're still in one, you don't really get below 30 on RSI very often. Usually they kind of start cleaning things up before then. So this is very interesting, right, that we're approaching 30. And it could be a sign, a very early sign that it's over if you start getting into the 20s. But the problem with reading it that way is going to be the Fed meddling. You know that, prior to the Greenspan era, there was, I think, less meddling. They definitely meddle more and more these days with what's happening because everything's so dependent upon everything else because they've created this incredible Ponzi scheme. So it is what it is. But you've got this situation right there that makes a lot of sense. Otherwise, you've got all the levels that I can possibly provide with apologies because I just out of habit did this the other way. So my bad. But yeah, you've got all the levels there. The white ones are going to be your flat lines, whereas the colored ones are going to be your fibs and things like that. Okay, the purple one I think is the last price, right? 448.75. If you're wondering, well, why is that color? It's because I think that's the last. So that gives you an idea on levels that I would be trading. I think you're in a volatility storm. So if you're, again, if you're looking for a prediction, it's hard for me to really make a prediction here because I don't know the weekend news, right? So I said on Cocktail Hour that I would go, and I actually said it in the video, and just for next time, knowing people couldn't trade it, but I just said what I would do is I would overroll. If I were bearish and had a nice week, I don't think it's over yet, but I wouldn't stay with like a nice 75 delta put. I would take the money and run and probably roll to 30, 35 delta. So I'm still in, but I've got a lot less risk if these guys do engineer something over the weekend. And if the financial system starts to show signs of cracking, and it could because of what's happening in Japan, they're expecting, as it stands now, there's some players out there that are expecting a massive downdraft on Monday as well. And everyone knows that there's ties between everything, especially the yen, the carry trade, all that type of stuff. And that's where you're at on that. And so if that starts to unfold, and did I do this wrong? I'm going to start from here. Let me see if it lets me get this done better this time around so I can get the fib on there the right way. Yay. And I did it the right way. I think this, that's so ridiculous. but I just got to use certain things more. Let me get the top price there is 228.63. So just one little modification to that high. And then the low down here on this major burst is going to be 191.34. So I'll just click my way to that. And that way it won't mess too many things up. But those are the fib levels kind of hidden within there. I'll try to enlarge those a little bit. This one's probably the hardest one. It's 205.58. The other ones are probably easier to see, but this one here is 205.58. That would be your next one. That's going to dovetail right with that rising red 100 SMA. And you also have a support line down here as well. And there's a flat line right just below there, which I'll try to highlight at risk. I'll try to highlight it. Oops, let me see if it lets me. Now you can see there was a little bit of a dot on that. I don't want to change the color, but I think you can see that it's a 204.63. The SMA for the 100 is 205.35, and then we're at 205.58 here on the. Oh no, I see. I just out of habit. Did I really do this one again? Yep, I did do it again. My gosh, I just can't break the habit. I'm so used to doing it the other way. And I thought I did. Man, my gosh. I'm trying to use these because they're just so much cleaner than my other charts, and it's not working. It's backfiring. It's backfiring on me. My gosh. All right, maybe I need a vacation at this point. It's been a long time. 228.63. I think that was the right number. 228.63 is the right number. And then, my gosh, I'm so tired. I need to get more caffeine or something. And then I've got 191.34. So let me fix that. 191.34. And my apologies for the umpteenth time. Let's see if that changes things, and it does. So 205.59 it changes. It's very close to where we were on the other one, but it's 205.59. So right in there. So again, I'd say there's a support zone kind of waiting for this thing, and you've got a flat, you've got an SMA, you've got a fib, and you even have just below there my hand-drawn support line, which is a little bit lower, but I think you're coming into a zone of support if you continue to drop. But that would be down a little bit. Let's say that as Ryan and Greg call it, the OS level would be 203. So if the Qs drop below 203, not that there isn't more support, there is, but that's sort of like, oh no, the whole sort of support that was angular support that was maybe part of this whole thing, this whole breakout attempt is shattered as well. Just everything getting shattered, just obviously not good. But otherwise, I don't have as many lines on here in terms of flat lines. I don't know what happened to those. I did have a few more, and unfortunately, I think there's going to be one right near there. There's another one I'll add there. I'm just going to keep doing it the old-fashioned way, not to create trouble. But there aren't that many flat lines, frankly. I could probably squeeze something in. You probably have to, because it's sort of not a lot to work with, we probably have to add one up in there. But really, I think you're looking at gap closure potential, right? If they do find a way to rally this stuff. And if not, they're just going, all the action that the IWM has produced, and a lot of sideways-ish type motion over a long time, there's going to be a lot of support levels down there. But there's obviously, right, there is more to this. So if it lets me get us more, there's a whole, there are other gaps in here, right, that are unfilled. So that would be more of a doomsday scenario than obviously this gap up here. But there's other issues there. You're still not really oversold yet. If you look at the RSI, you're at, I think I've got it coming in at 42.61. So there's plenty of room there still to drop before getting officially oversold. But yeah, things are looking pretty bad. I think it's a good thing that July's candle benefited from markup madness, where they really did, with Powell and the whole works, they were able to really put a nice markup madness together. You can see this looks a lot like the IWM, but that really made that monthly candle for July not look as bad as it could have. And so that might have really helped a lot for now. We'll have to wait and see. It might just be news dependent. It might not matter at all. But I've got a line in here. You can see I've got the flat lines. They're really, I could add a little bit up here for us, but there isn't really much to add up there. So I'm going to put that there. And what I'll try to do one more time is I guess I've got to go the opposite way, and I just can't bring myself to do it because out of habit. But let me see if I can finally get one right. And my mouse is now fighting with me. Okay, what I might do here is just delete that one. Delete, and then start over. So let me go to the top. I'll go to the top up there just so we can see if there's some confluence here. And I'll go down to this low where they really launched it from, and then just make the adjustments for us. So that low is 376.14. And then we've got 412.34. I'll make this manual adjustment so nothing gets screwed up. That ought to at least give us some fibs to sprinkle in there. And okay, vacation time. Somebody call Mark Lopresti for me. At this point, I need a vacation because I just keep doing this the wrong way out of habit. I can't stop it. Well, once I get started with it, I'm just doing the exact, I'm just doing the exact same thing I've done way too many times, as you can tell. It's just so, so stupid. Oh boy. That was 412.30, 413.86. Okay. Well, I even had the wrong number, it looks like. And then 376.14. How am I off by that much? Yes, I am. Right? This low right here. Yep, 376.14. Okay, so let's see now if we get a deeper pullback. So the toughest ones to see for everyone are probably going to be let's see, probably I hopefully enlarge those enough that we're coming in 390.55. 384.21 would be the next fibs. But let's see, you've got the 100 SMA right there. I've already got a flat line near there, 391.93, which is right near there again. And then you've got your support line, I think, that's there, which is right above the 150. So these things are going to be coming into support. The OS moment would be if the 150 just doesn't hold. If that doesn't hold, I think that opens the door to the 200. That is obviously going to, and that's not, it's short term obviously bad, but long term, right? If it gets a lot of this out of its system, the overboughtness and all that, it's not the worst thing that can happen. It's actually probably a good thing if it can hold trend, once it gets there. But that's way too far ahead. But you can see the levels. I really can't add many levels for us up near this area. I've got to really rely on just what we have down here for now. If you wanted to, we could probably squeeze a little bit more in here. You could probably, if you really wanted to say, well, I want to trade very tightly, I could probably get that one in there as well. I do think you see enough price action to justify adding one there. There's probably, honestly, another one right in here that's right bisecting sort of that whole thing too. That one's there too. In here, there's another one. I'll add this one. This is for people that want to trade it a little bit tighter. But I do think you're coming, you're a few percent away from coming into what should be a pretty solid confluence of support zone. So those are really all the levels that I think it's probably worth sharing. And I just would, only because I expect volatility, I think news is going to come out or not come out, and the market's going to be volatile probably one way or the other would be my guess. I don't know if all the stuff settles down by the middle of the month, it could be a different story, and you might finally get a little bit of calmness until you come back from your Labor Day. That often happens. This year doesn't seem like the year for that to happen, though. I'm just saying that's a tendency that I've, a lot of people have observed, myself included. What I would say is on the sectors, because we ought to cover these. What I would say on the sectors is that if you look at everything here, we basically just went risk off because you have XLP defensive, XLV defensive, XLU defensive. Those are all bid and made new highs on Friday. Meanwhile, other important sectors like financials clobbered for 2 sessions, energy clobbered for 2 sessions. Former leader XLK, former leader XLC, which was hanging in there, both clobbered for 2 sessions. Transports, one of my canaries, along with IWM, clobbered. Discretionary crushed. And then kind of like Dow-esque stuff like materials and XLI industrials, basically suffering the same fate as XLK and XLC. So those also became risk off. So there's really a risk off picture here. I don't see how you get away from it. The exception might be real estate. They've got real estate kind of making that new high. Remember, like, wouldn't fight against it. I don't want to speak to the specifics of XLRE. I think I had DHI and another real estate ETF that we put in this week. It might have been home builders. I can't remember. Let me see if I can bring that up just on Thinkorswim so I don't flub it up. I think I had a couple ideas in DHI and XHB, and I was very reluctant to do it. But there was a good drop there, a good sort of. I was reluctant to do it because these are just not. They were really near highs, and you could see like what the trend has been. It's kind of hard to say, well, that's an ugly trend, but I felt like with what was happening in the market or could happen, it was worth it. Unfortunately, they both cooperated, so both of them reversed from when we were able to spot those trades. But to me, this is the big area. I've been dead wrong about this in terms of like how the prices held up in these instruments. Luckily, right, I don't trade off of my opinion, so of the fundamentals that much, so it didn't really hurt me. It might. I don't even think it hurt subscribers. In fact, I think they might have come out of trading these things with profits just because we might have been lucky on some pullbacks or this or that, but over the course of time. But if this thing really does go to hell in a handbasket, I don't know how this stuff is holding up. I don't know how commercial real estate is holding up. I feel like those places are going to see. It might just be too many people short them. I don't know. It's possible, but I feel like that's an issue that's waiting to emerge potentially if we get really ugly scenarios that begin to play out over the balance of the year. SMH, right? We got to comment on this former leader. You can see what's happened there. The whole AI situation seems to have unraveled. And again, not to toot my own horn, I'm just saying that we did at one point talk about the fact that I don't deny that AI can be incredible. I just was wondering, is it really going to be where they can almost instantly take these new AI developments that were being pushed a couple of years ago and turn them into these really great gains in terms of efficiencies, et cetera, and that really translates to the bottom line that quickly. I think usually there's a hype cycle. And, again, we said it's great to buy the early hype, and it was. So I think what you do is you buy the early hype, but a lot of times this is what happens. There's just sort of like deflation of everything where it doesn't pan out as quickly as some of the true believers expect it to. And then people sort of sour on it, and then it has a new life to it. It's just part of a larger cycle, in my opinion. So I wouldn't give up on it. I certainly wouldn't give up on it. It's just that, again, if you're trading it, you've got to handle things differently. If you're a long-term investor, I don't really want to talk about something I don't know that much about, but I just feel like overall that story has legs to it. It's just a question of, it has to go through this cycle. It has to go through the hype, and then, people start capitulating, get out, give up. Then that all sort of works its way through the system, and then they're back at it again with these things. That's what I think is going to happen during, let's say, relatively normal economic times. Probably worth flashing the market breadth really quickly. Market breadth, I would say, took a pretty decent hit. Still not atrocious, but look, it's sort of all rolling over as the market itself is rolling over. And I'll just put SPYs up there for reference if somebody wants to just look at the measures themselves aren't dependent upon the symbol at the top. It's just one of the basic market breadth screens that I share because it's not too bad to look at, I don't think, overall. But you could see, right, is what you would expect. You got new highs, new lows, where that was ramping up, and recently that sort of really tailed off. The normalized, new high, new low. You're seeing that highs really backed off, right, as the week wore on, and you get these new lows happening, and they're some of this shot up with new lows to something you haven't seen in about 3.5 months. So it wasn't anything insignificant. I don't think it's historic in any way. I'm just saying that, yeah, it definitely showed. So it's about what you'd expect, I think, right? There's nothing to me on this particular screen that shows me anything special. McClellans are both rolling over, and naturally the McClellan oscillator, which is more sensitive, that's rolling over harder. It's actually taking out this low. McClellan summation is naturally slower. That's the way it's designed. It is starting to roll over. So, a lot of the improvements we saw when things were working out, they were working quite nicely and generally uptrending as we were moving into this area, which is why we were saying breadth wasn't too bad. Breadth actually was pretty solid in a lot of ways, but things change, right? That's what happens. Trying to think of what else I wanted to show. Oh, I know what I want. Okay, let's see if we can get to this chart here. This chart here is just another chart I use for sort of intraday stuff. I just want to point out, right, that yields dropping, people are heading into this area, and as a result, the yield is crashing. You've got the dollar getting smashed, and you've got the VIX, VIX, and VXX, right? You can see what happened there. And so that was another part of our discussion. I went and looked back, and I think it was right near Independence Day. So it probably was like the July 5th video. We were talking about doing something, right? Starting to do something potentially with the VIX in terms of putting on volatility, net long puts, collaring things, getting ready, positioning yourself with stuff, because we thought it was time. We thought that, with the earnings season coming up and the way the VIX was hitting its sweet spot in the second half of the year, it was time to do that with how cheap it was. And I think that's just about when that 50-cent player returned to the markets and bought some out of the money calls in, I think it was September. And we kind of hit on that. And, this is not a pat yourself on the back thing, but this is what can happen, right? So that's why you have to, if you're anyone that believes in downside put butterflies or these types of things, you've got a net long put positions you can set up, back spreads, there's so many ways to go. But when it comes to these things, like, you really have to position yourself when everybody's not interested in that. You have to be the one of the few players that is, because they're giving away something. And remember, we talked about it. Volatility was at a 5-year low, right? And they even just whacked. By the way, I forgot to mention this. They even whacked XAU, right? So they really just sold the daylights out of most things other than defensive things. I'm just saying, like, this stuff we just looked at here just confirms that to me more. Even more so. I'm trying to think of what else I might be able to show, because I don't really plan on going through everything that we normally do in terms of all the little sectors and wrinkles. I just think you're in I think overall you're in a risk off situation until further notice. That's where I think you are. So without intervention, I think that even they could certainly use a few earnings reports to just gap things, and that's what they do, especially if we get even more oversold. So you've got to be smart with your trading. Really smart with your trading would be my guess. But I just feel like there's going to be pressure. And if the Fed doesn't succumb to that pressure sooner, and they want to see more carnage to then justify them doing that, they're probably going to let the carnage occur. And then they'll have that to hide behind. Well, look, the market was heading into a full-blown crash, and we had to revert that to save the system. That's the kind of thing I think will happen. And what I would say on that is, again, right, you just keep rolling, right? So going back to the other charts we were looking at, if I can, if it lets me. That's why I'm trying to include a lot of levels, because, and we always answer requests for more in the forum and put new ones out every day. But we eventually, if we have to, right, I'll start adding some flat lines and things like that, and looking at bigger movement to find possible fibs and things like that. But they, you got to take your pick. But I would just be, if you feel like, hey, this thing's really coming apart at the seams, then you really kind of need to make sure, like, okay, I've rolled, like I've made a bundle. If this thing does come apart at the seams, I've made a bundle, and I've got to be happy with that. But I'm going to stick with it. But I'm going to do it through a roll, because that's the thing. Like, you've got to make sure some of that money is locked into your account. It's okay to give some back on rolls, or ideally your fourth roll, but it's really super frustrating if you happen to take a coffee break, go make yourself a little coffee or whatnot, you come back and it's 3 minutes later, and that's when the Fed stepped in or someone stepped in, PPT, whatever the case may be, and expect it. I don't think you can say, well, they shouldn't do that. You just have to expect that they will. It's just a matter of when. So again, I think the discipline is going to be what gets you through. And I'm probably telling you to short circuit the biggest windfall, if there really is a massive thing, but a massive sell-off, that is, but that's unrelenting. But that's rare. Like, they really have halted those. You don't really get the 1987 stuff these days. Now, the news could dictate you do get something like that. So I don't want to rule that out. It's just that ever since then, with the PPT, they have done a lot of short circuiting of sell-offs, and there's been sort of like a timely reprieve or something, you would say, from them. And then you get this bounce and so on and so forth, and it can frustrate the living hell out of you if you haven't done anything. So the rolling strategy allows you to at least, right, come away probably very happy, probably not looking for an island to buy. That's the downside. You don't get to go island shopping, but you probably still, no matter what scenario plays out, you probably walk away a lot happier than if they shredded you with sort of like a surprise or emergency cut. Now, they often do that kind of thing over a weekend after they talk to all their Wall Street friends who tell them what to do. And then they do it. So I don't get those calls. Probably a lot of you don't get those calls, but they do call the usual suspects who pretty much dictate things and then position themselves accordingly. And then the then the rate cut comes through, and that initial squeeze tends to happen. And again, that's what I would expect based on my experience. But we have someone differing on cocktail hour. They might have maybe they've got a great point to make. I don't know, but my experience has just been the initial results are a squeeze that burns off, and then after the squeeze, you just get the selling begins again. But you just don't know, right? You don't know what extent of a cut you'll get, even if you will get one. And there's so many if this then that things that are tough to say. But safe to say that we do know that there's a volatility issue upon us, and I do think it's going to take more than garden variety news to really keep the market afloat. Working its way back up in a meaningful way. I think there's more selling to come if there's no intervention in this market between now and the next Fed meeting. So I guess I'll end it on that. I want to thank everyone for tuning in. I hope I made it clear that we weren't really bulls. I don't know where that came from. I hate to harp on it, but it just shocked me that someone thought that we were bullish. I don't know. Again, don't know where it came from. I thought we got some good warnings out there for people to be ready for this, really in the lead up to this, not knowing what would happen, just trying to be prudent. That's all, time wise, and knowing that this EPS season could be something that mattered, and it seems to have. So at least for now. So on that note, everyone have a great weekend. Have a great week ahead. Trade with discipline, and I think you'll be rewarded for that. I think there's going to be a nice movement that's to come our way. I don't think we're out of it yet, so I think you just got to keep stay locked in on just being disciplined. Things should work out. So everyone take care, and thanks again for tuning in.